Today, we're going to talk about something that can make any taxpayer a little bit nervous. What actually happens when the government thinks you've underpaid your taxes? We're going to break down the entire process of how tax authorities recover what they call escaped payments. So let's just dive right in.
I mean, it's a pretty common fear, right? You file your return, you think you're all done, but there's that little nagging thought in the back of your head. Did I get everything right? What if I made a mistake? Well, today, we're going to walk through exactly what happens when the tax authorities suspect an error was made.
Okay, first things first, let's get the terminology straight. The official term for any underpaid tax is an escaped payment. Now, it sounds a little dramatic, I know, but it has a very specific legal meaning that we're about to explore.
So what does that really mean? Well, at its core, an escaped payment is basically any tax you were supposed to pay for a certain year, but you didn't. And this can cover a whole range of situations, from, simple, honest mistakes to much more complicated issues.
So, according to the law, a payment is officially escaped if you understated your income, maybe you claimed too many losses or deductions, or you misreported some info that ended up lowering your tax bill. It also covers things like your income being taxed at a rate that was too low, or if something was wrongly labeled as tax-exempt, or even if you got way too much relief. It's a really broad net, and it's designed to catch pretty much any shortfall.
So, how does this whole process even get started? Well, it's not random, I can tell you that. There's a formal procedure that the tax authorities absolutely have to follow. Let's take a look at how it all unfolds.
The whole thing begins with the Deputy Commissioner of Taxes. Now, based on information they might get from an audit or some other source, they have to have what the law calls a reason to believe that a payment has escaped. And this isn't just a hunch, okay? It has to be based on some kind of concrete information.
So once they have that reason to believe, they follow a really clear set of steps. And this is super important. If you've already filed a return for that year, the Deputy Commissioner can't just act on their own. They need to get written approval from a supervisor. This is a key check and balance. It's a safeguard that's literally built into the system for you, the taxpayer. After that, they'll send out a formal notice telling you to file a new, corrected return and, of course, to pay the amount that was missed.
Okay, so a notice has arrived. This is a really critical moment. What you do next, well, it determines everything. You basically have two paths you can go down.
So on one side, if you comply completely, you file the new return on time, you pay the full amount, you fix the issue, the whole process ends pretty simply with a letter of acceptance. But if you miss the deadline, or you don't pay up, or you just don't address the problem, you're going to face a formal assessment, which is a much more serious and involved process. The takeaway here is pretty clear. Compliance makes everything simpler.
Now, getting a notice like this might have you wondering, wait a second, can they just go back forever? What about something from like 20 years ago? Well, the answer is usually no. There are actually really strict time limits on how far back the tax authorities are allowed to look.
The magic number here is 6. Yep, 6. In most situations, tax authorities can only issue a notice for an escaped payment for the 6 years right before the current assessment year. This is called a statute of limitations, and it's another really important safeguard. It gives you a sense of finality, so you don't have to worry about ancient history coming back to bite you.
But, and this is a huge but, so listen up, there is one major exception to that rule. If you never filed a tax return for a particular year, that 6-year clock, it never even started ticking. In that situation, the authorities can go back at any time to recover the escaped payment. It's a really clear message that not filing at all is treated very, very differently from filing with a mistake.
So we've talked about the Deputy Commissioner's role, but the story doesn't actually end there. The system has another whole layer of oversight, a final review process just to make sure everything was done by the book.
So the big question is the Deputy Commissioner's decision the final word on the matter? Not always.
This is where a higher authority, the inspecting additional commissioner, can come into the picture. They have the power to review any order from the Deputy Commissioner. And if they think the order was erroneous and prejudicial to the interests of the revenue, which is just a fancy way of saying a mistake was made that cost the government money, they can step in and change it.
And the law is actually very specific about what counts as erroneous. An order can be overturned if the law was interpreted wrong, or if the tax officer didn't do their homework and verify things properly, or if tax relief was given out without a full investigation. It also covers cases where official instructions weren't followed or income got put in the wrong category. It creates a pretty clear framework for accountability.
And just like the initial process, this supervisory review has its own time limit. The inspecting additional commissioner has 4 years from the date of the original order to revise it. After 4 years, that original decision is locked in.
So when you put all these pieces together, what you see is a system that really does have checks and balances. The taxpayer has a clear path to follow to make things right, and the tax authority has its own internal controls, like needing a supervisor's approval and having high-level reviews to make sure the rules are being followed correctly. It's a system that's designed, at its heart, to be fair. Honestly, just understanding this structured process with its clear rules and its layers of oversight is pretty empowering. It shows that while the main goal is to make sure everyone pays their fair share, the process itself is designed to be systematic and accountable. So, what does this balance of power really mean for the relationship between a taxpayer and the state? That's definitely something worth thinking about. Thanks for tuning in.